No shortage of compelling news stories today. Vince Lanci is up next. First news item, Vince. HSBC coming out today saying they have their gold allocation in their strategic portfolio in favor of equities and Treasury inflation protected securities. They said this was a move to reduce volatility. But my question to you, Vince, is the message here that the bank is taking a less favorable view of the metal as an inflation hedge?
Well, I think it's big news that they would come out so publicly about it, unless their own clients were already out of it. But just speaking analytically about it, if the euro crisis is over, if the world is recovering, then one of the legs for owning gold, which is fear of fiat currencies tumbling, is knocked out for owning gold. And they're releasing this report, on the back of the Goldman report. So it had an effect on the market today. The dollar was weaker today relative to the euro, I believe, for most of the day. So, your dollar-euro relationship, your dollar-gold relationship, did not hold steady today because people were getting out just because someone said to get out. Whether they're right or wrong remains to be seen. But I rarely see banks make such public commodity statements unless they're taking the other side of the trade. But we'll see.
Next news item, Vince. Goldman Sachs coming out earlier in the week with a bullish call for gold within the next 90 days, but bearish long-term. They're looking at $1,200 an ounce by 2018, 5 years from now, Vince.
Yeah, banks rarely go out 5 years with a prediction like that. And first, I would say I doubt the analysts will be working there in 5 years, so they probably won't have to answer for their predictions. But to take it seriously, their analysis basically says that if you look at it from a risk-reward point of view, they're saying, hey, there's really not much more that's going to happen to give you upside in gold from an inflationary point of view, or what I should say, a printing point of view, because, and on the flip side of that, we think that as inflation starts, the Fed will start raising rates, and interest-bearing assets will compete with an asset like gold, causing it to decrease. So it's not a poor analysis. However, 5 years, a lot can happen, and I think there are some things that bear more assessment.
Such as what, Vince?
Well, I mean, when you have a Fed chairman who says he's not worried about inflation, he's worried about employment, he may be inclined to let inflation get a little bit higher before he raises rates. So you may have people getting out of their gold, and then you may have inflation pop up a little bit, but unemployment remains high, although today's numbers don't show that. And the Fed chairman could just say, okay, well, we're okay. And that's one thing. The other thing is what I call a tip of the iceberg trust theory. A government or a Fed raises interest rates to combat inflation, and initially everyone says, oh, that's the end, punch bowl's taken away, and assets like gold sell off. And then they do it again and again, and then what you start to see is a mistrust. Oh, there's a lot more inflation than meets the eye. Maybe we should still own a little bit of gold. So there's a lot that can happen between now and 2018, and inflation is not the only reason to own gold. But their analysis is it's common sense. I mean, interest rates are going to go up 5 years from now if we recover.
Speaking about trust, Vince, this will help me segue into my next topic. Germany wanting their gold back from Paris and New York. They're looking to move their gold back to Frankfurt. Now, I've asked John Nadler and Peter Hugg their opinion on this topic earlier in the week, and I'd like to get your thoughts. Do you think this shows distrust in the central banking system?
October, the German bank said, the Bundesbank said, to paraphrase, we trust the Fed. We want our money there because it's liquid and we can convert it to dollars or British pounds in the case of Great Britain at any time. And it's like they use an analogy, which is always dangerous if you're a banker, that sometimes it's more liquid to have your money at a bank than or at a bullion dealer or a bank than it is to have it at home. Some sort of allusion to home is not as liquid as the currency forex places. And in November, afterwards, the U.S. Fed used that statement as an example. I forget who it was.
Bill Dudley.
Yeah, Bill Dudley. Bill Dudley says, "See, they trust us, and our relationship is great." And then in January, the Bundesbank says, "We changed our mind. We're going to take a lot of gold back, and we're going to take gold back for the same reason we said we wouldn't take gold back." If you watch the words are because we need to be able to put our money in different currencies, and we need that money liquid because essentially it's more liquid in home because we can put it on other exchanges.
So, Vince, are you saying Germany wants to be able to sell its gold for Eastern currencies?
I think before I put on the conspiracy part, I think they're lying. Okay, they're lying in their use of words, and that's what politicians do. But there's truth in what they're saying in that we keep our gold, we keep some of our gold at the U.S. Fed so that we can make it into dollars if we need them for our FX reserves. We also are realizing that the dollar is shrinking in importance in the world, and we want some of our gold to be able to be sold in, say, Shanghai and get yuan or the renminbi or whatever the currency actually is called now.
Vince, let's talk about that 7-year term. Is that normal that it would take place over this span of time?
I don't have an answer as it pertains to that particular event, but I have an answer as it pertains to managing expectations. 7 years is a long time. 7 years makes people less nervous. It's not happening overnight. That's one thing. The second thing is it ain't easy to move a lot of gold overnight.
But Vince, do they really need to physically move the gold?
That's you know what? That kind of puts a pin in my balloon of what I just said, and I don't have a really good answer for you. But it sounds like you're saying, hey, the gold can be in the U.S. They can just sell futures in Shanghai, and then they can ship the gold over, or rehypothecate it, or something like that. And I think that's a legitimate point.
I guess what I'm getting to at, Vince, is that some people in the blogosphere were alluding to the fact that they needed the 7 years because the gold might not be there.
It is quite possible. Now, I don't know what's in the Fed vaults, if there's a bunch of moths in there or if there's a lot of gold, but it is quite possible, and I don't know constitutionally if it's legal, it is quite possible that the Fed has loaned gold to bullion banks, which have then shorted it in the market, taken the dollars, and put it into higher interest-bearing particles. It's a good play, but I will say it is definitely... I would not be surprised if the Fed has loaned gold using unallocated accounts to bullion dealers over the years.
Vince, let's move on to the next topic before we open a whole can of worms here. Standard Bank coming out saying that physical gold demand has been unusually strong for this time of year.
Right. They did say that. I'd like to make more of it than it is, but they said in the story that we believe a big portion of this is the result of the Indian tax increase. India's got some problems right now. They need to raise cash, and one of the ways they're doing that, they need to raise cash to buy food, and one of the ways they're doing that is raising taxes on gold. And so basically wedding season came early. Oh, they're going to raise an excise tax on gold, so let's buy it now.
Vince, you mentioned India, biggest buyer of gold in 2011. Government comes out 2 days ago saying they're going to raise taxes on gold imports, basically to reduce record current account deficit and to moderate demand. My question is to you, why would the Indian government want to dampen the appetite for gold?
Well, that's a good question. Why would someone want to kill the industry that is one of the important, columns of their economy, and that's one way of looking at it. Unfortunately, a government looks at it more like, hey, the most money generated by this country is in jewelry sales, let's tax it.
Vince, thanks so much. That's all the time we have for today. Thanks for joining me.
Thank you very much, and hope to see you soon.
And thanks for watching this edition of Reset. You can email me any comments or questions at newsfeedback@kitco.com or tweet me at Daniela Cambone. Thanks for watching.